This is an analysis from Alpha Business Media.
Okay, so picture this scene with me. A boardroom in Kathmandu. You've got the top floor panoramic view of the Himalayas, this, big polished mahogany table, expensive bottled water at every seat. And there are men in sharp suits flipping through these, massive binders of financial reports. It looks serious. It looks professional.
It's the perfect image of corporate governance.
It is. But what if I told you that in many of Nepal's top publicly listed companies, that entire scene is basically performance art?
That is a bold claim.
It is, but it's the central idea of the report we're breaking down today. It's called corporate governance, the rubber stamp boardroom crisis. And it introduces this fantastic concept called compliance theater.
Compliance theater, I like that. It sounds like a drama production.
It essentially is. I mean, the report argues that on paper, these companies, they're immaculate. They tick every single box, audit committee.
Check.
Risk management framework.
Desk independent directors.
Absolutely.
Yeah.
But the source argues this is a carefully constructed facade. And that's our mission today, really, to peel back that facade.
To understand the difference between form, so looking the part, and substance, actually doing the job.
Exactly.
And this is so crucial. We aren't just talking about abstract rules. This affects everyone. If you have money in a bank, if you own shares, or if you care about foreign investment coming into Nepal, this theater is costing you money.
So let's unpack it. We've got a bit of a roadmap for this deep dive. First, we're going to look at the anatomy of a captive board. I mean, how do you even build a rubber stamp?
Right.
Second, the financial cost. There's this thing called agency risk. And third, the FDI litmus test. Why this boardroom culture is essentially a giant do not enter sign for global investors.
Let's start with the anatomy, because I think most people would assume, if a company's following the law, the Companies Act, all the directives, then everything must be fine. The law requires independent directors.
Right. And the whole point of an independent director is to be the referee. They're supposed to be that one person in the room who doesn't work for the company, isn't part of the family that owns it.
They're there for the minority shareholders, the little guys.
That's the idea. But the report details this whole mechanism that completely subverts this. They call it the curated search.
The curated search sounds like something for a museum.
It does, doesn't it?
It's much more cynical, though. The promoters, so that's the majority owners, usually a powerful business family, they don't go looking for a qualified critic.
No.
They are not looking for someone to challenge their strategy. They go looking for a safe pair of hands.
So who are these people? I mean, who qualifies as a safe independent director?
The source identifies a few archetypes.
Yeah.
You've got the retired bureaucrat, who needs a prestigious post-retirement gig. You have the non-confrontational university professor, or maybe a business associate from a totally different industry who just, understands the code of silence.
Okay, so on paper, these people look independent. They don't have direct financial ties.
Technically, yes, they meet the legal definition. But socially, they are completely bound to the promoter. Maybe they were university classmates 30 years ago.
Or distant relatives.
Or maybe the director just owes the family a favor. I mean, the report uses a really brutal phrase here. It says, independence is a legal fiction.
Wow. Independence is a legal fiction. That hits hard. So their loyalty isn't to the company or the shareholders.
No, it's to the person who gave them the seat.
And that must create a very specific kind of atmosphere inside the boardroom.
Oh, absolutely. The report describes the meetings as choreographed events.
I love that detail. It implies a script.
In a way, there is one. The agenda is pre-circulated, sure, but the really critical information, the data that might actually raise a red flag, is often withheld, or it's buried in a 1,000-page addendum no one can possibly read.
So even if you wanted to ask a tough question, you don't really have the information to do it.
Exactly. But I mean, usually you wouldn't even want to ask. The culture in these boards sees dissent as disrespect.
Right.
If you raise your hand and say, excuse me, Mr. Chairman, I think this loan is a bad idea, you're not seen as being diligent. You're seen as being rude. You're insulting your host.
So the role of the independent director just gets reduced to what? Nodding.
Nodding and signing. That's it. They are there to affix the seal of approval to decisions that were probably made weeks ago at a private dinner where they weren't even invited. That is the definition of a rubber stamp.
It's fascinating because it flips the whole idea of governance on its head. It's not about oversight, it's just about validation. But okay, let's move to the cost. Why should you, our listener, care? If a bunch of rich guys want to play theater in a boardroom, does it really hurt anyone else?
It absolutely does. And this brings us to the concept of agency risk. Now, usually in a Western business context, this is about the conflict between managers and owners. The CEO who buys a corporate jet instead of paying dividends.
Right, the manager spending the owner's money on perks for themselves.
But the source argues that in Nepal, and actually much of Asia, that model doesn't really fit. Here, the promoters are the managers. The families own the controlling stake, and they run the show. So the real conflict isn't manager versus owner, it's the controlling promoter group versus everyone else.
And everyone else is the minority shareholders, the public, maybe the bank depositors.
Precisely. And the risk isn't that the manager is lazy. The risk is that the controlling family is using the company's assets to benefit themselves at the expense of everyone else.
The report gives two really clear scenarios for this. Let's walk through them because they make it so concrete. The first one is in banking.
And this is the really high-stakes scenario. I mean, banks are the backbone of the economy. So imagine a commercial bank where the board is dominated by one powerful trading family.
Okay.
That family also owns, let's say, a huge import-export business, maybe some hotels, a factory.
A whole conglomerate.
Right. The pressure on that board, including those independent friends, is to extend credit to the family's other businesses. These are called related party loans.
Which is basically lending money to yourself.
In a roundabout way, yes. And because the board is captured, these loans often have preferential terms, maybe a lower interest rate, maybe the fees are waived, or, and this is the most dangerous part, the collateral is inadequate.
What do you mean?
They might accept a piece of land as collateral that's valued way, way higher than it's actually worth.
So the bank is taking on a huge hidden risk just to subsidize the family's private business. And the independent director, whose one job is to say, whoa, wait a second, just sits there.
And says nothing, because to object would be to betray a friendship. Now, here's where it gets really dark. If that family business fails, if they make a bad bet,
the bank is left holding the bag.
The benefits were privatized, the family got cheap cash, but the losses, they're socialized. Depositors are at risk. Minority shareholders see their stock value just tank. And if it's big enough, the central bank, so the taxpayer, has to step in.
It's a mechanism for transferring wealth from the public to the promoter. And the bank is just the vehicle. That's actually terrifying.
It is. And the second scenario is a little different. This is more for, say, manufacturing or hydropower. The report calls it the ego project.
The ego project sounds like empire building.
That's exactly it. Without a strong board asking hard questions about return on investment or ROI, promoters often push for these massive expansion projects just to have a bigger kingdom. It's not about profit, it's about prestige.
I want to build the biggest cement factory in South Asia, whether the market needs it or not.
Precisely. So they pour the company's profits into these huge low-yield projects. And the source uses a great term for this: internal capital starvation. The company's making money, but instead of giving it back to shareholders as dividends or investing in efficiency, the money gets sucked into these ego projects. It just drains value.
And the market has to notice this, right? I mean, investors aren't blind.
Oh, they definitely aren't. And that's why these companies trade at what the report calls a governance discount.
A governance discount.
Yeah. Smart investors look at the stock and say, well, the assets are good, but I don't trust the board. I don't trust them to treat me fairly, so I'm going to pay less for this stock.
So if you're a promoter clinging to this rubber stamp model, you are literally devaluing your own company. You're paying a penalty for your own control.
That's the irony of it. But for a long time, this was just, a domestic issue. We could sort of shrug and say, well, that's just how business is done here. But things have changed. Nepal is trying to graduate from LDC, least developed country status. We need billions.
And we can't raise that kind of money just from the local market. We need foreign direct investment. FDI.
Exactly. And this is where the rubber stamp just hits a brick wall. The report calls this the FDI litmus test.
Because the investors in Singapore or London or New York, they couldn't care less about who went to school with whom 40 years ago.
They operate in a totally different universe. Global capital, we're talking private equity funds, development finance institutions. They run on ESG frameworks: environmental, social, and governance. And for them, the G is non-negotiable.
It's their main risk mitigation tool.
It is. And the source says these foreign investors conduct forensic analysis of the board.
It sounds intense.
Oh, it is. They don't just look at a bio, they look at the connections. If they see an independent director who shares a surname with the promoter or sits on 5 other boards with the promoter's cousins,
Big red flag.
massive red flag. They just assume the board is captured, they assume the compliance theater is in full swing, and they walk away.
They don't just want warm bodies in seats.
No, they demand something called cognitive diversity.
Cognitive diversity. It's a bit of a buzzword, but what does it actually mean in a boardroom?
It means having people who think differently. It means having a real financial expert who can actually grill the CFO on the numbers, a tech expert who can challenge the digital strategy. They want friction. They want debate.
Because in their world, debate prevents disaster.
Exactly. And to illustrate this, the source brings up that famous case from India, the Satyam Computer Services scandal.
Oh yeah, back in 2009.
This is the perfect cautionary tale. Satyam was a giant, one of India's IT jewels, listed on the New York Stock Exchange. It had this star-studded board, professors from Harvard, top CEOs.
But they had the form. They looked perfect.
They looked perfect. But the founder, Ramalinga Raju, had been cooking the books for years, just falsifying accounts on a colossal scale, over $1 billion in cash that just didn't exist.
And the independent directors just missed it.
Completely missed it, asleep at the wheel. Or maybe just too polite to ask for the raw bank statements. When that scandal broke, it was a watershed moment for India.
And the aftermath is the key lesson for Nepal, isn't it?
It is. That scandal directly led to the Companies Act of 2013 in India, a massive regulatory overhaul. It created strict liability for directors. It made them personally liable for negligence. It forced real independence.
And did all the money flee? Did investors say, oh, it's too strict now?
The absolute opposite. Confidence came flooding back. Foreign investors pour billions into India now because they trust the governance structure. They know there are real checks and balances.
So the takeaway is stark. You cannot unlock that level of investment with a rubber stamp board. It's a do not enter sign.
And it seems like the regulators here are finally getting this. The report mentions SEBI, the Securities Board, and the Nepal Rashtra Bank are waking up.
The era of lax enforcement is ending.
It seems to be. The source outlines 2 possible paths for how this crackdown could happen. Scenario A is the incremental path. Just tightening the screws a little.
Like stricter cooling off periods, more disclosure forms.
Right. But the report is pretty skeptical about that. It suggests this might just lead to better, more sophisticated theater.
Meaning they'll just find a new friend who fits the new rules.
Right.
Okay, I won't hire my cousin. I'll hire my cousin's old roommate who I also control.
Exactly. It doesn't solve the core problem of intent. And that's why the source argues scenario B, the Big Bang, is more likely. Just because the pressure for FDI is so immense.
And what does a Big Bang look like?
Substantive reviews. So imagine regulators not just checking if a meeting happened, but checking the minutes to see what was actually said.
Was there any debate?
Did the independent director ask a single critical question? Did they ever dissent?
And then the really scary part for the current directors, liability.
This is the game changer, making board members personally and financially liable for negligence. If you sign off on a fraudulent loan, you don't just lose your seat on the board, you could lose your house.
That completely changes the calculation, doesn't it?
Yeah.
A retired bureaucrat isn't going to take that seat as a ceremonial honor if it carries the risk of bankruptcy.
It forces professionalism. If you're going to take that risk, you are going to do the work. The report also mentions creating national databases to prevent overboarding.
Overboard.
You know those people who sit on like 15 different boards? The professional board sitters?
Oh yeah, their name is on everything.
You cannot possibly do due diligence on 15 complex companies. It's physically impossible. The Big Bang would cap that, forcing companies to find new, genuinely independent talent.
So looking forward, the analysis really presents this binary choice for Nepali businesses. It's adapt or die.
It really is. The old model is you cling to control. You keep your cozy board, your secrets, your friends. But the result is that governance discount. Your stock stagnates. You can't raise capital, and you become what the report calls a corporate dinosaur.
And the new model.
You embrace the discomfort. You bring in smart strangers who will challenge you. You build a diverse board, and the reward is a governance premium. You become a magnet for capital because investors trust you. You get the cheaper loans. You get the foreign partners.
It sounds so logical on paper. Embrace diversity, get more money.
Yeah.
But the report ends on what it calls a hard truth. And I think this is really the human element of it all. This isn't just about changing laws. It's about changing a mindset.
It is about culture. A deeply, deeply ingrained culture. In many of these business houses, personal loyalty is valued far above professional duty. The source says this transformation will be deeply uncomfortable.
Because for a powerful promoter who built a company from nothing, poured their blood, sweat, and tears into it, an independent director asking tough questions doesn't feel like good governance.
No, it feels like insubordination. It feels like a threat. Why is a stranger telling me how to run my business? That is the psychological hurdle they have to get over. They see independence as a loss of autonomy.
But the economic reality is just.
Yeah.
It's unassailable. You can't run a global standard business with a village standard boardroom anymore. The world is too small.
That's the bottom line. Compliance theater feels safe. It feels comfortable to have your friends around the table nodding at your ideas. But it's actually more dangerous than doing nothing because it creates a false sense of security. You think you're protected, you think you have a real board, but the walls are just made of paper.
And when the storm hits, a financial crisis, a market crash, a need for a huge capital injection, that paper just dissolves.
And you're left completely exposed.
So here's the provocative thought we want to leave you with today. We're really standing on the edge of a major shift in Nepal's corporate history. The rules are changing, the money is changing, the expectations are changing. And as the era of the rubber stamp ends, the question for the country's powerful business families is simple. Will they continue to view independent directors as a threat to their control? Or will they finally realize that these outsiders, these critics, are actually the only key to their survival in the global economy?
That is the billion-dollar question, and the answer is going to determine who survives the next decade.
Thanks for listening to this deep dive into the boardroom crisis. We'll catch you next time.